When I was an IRS agent, I once walked into a hair salon for an IRS audit. The owner reached under the table and pulled out a weathered shoebox stuffed with crumpled receipts. That moment cost her over $10,000 in taxes, penalties, and interest she never should have owed. I'm Andrew Bosserman, former IRS agent turned tax attorney. In this video, we're going to cover Chapter 1 of my book, The IRS Survival Guide. And we're going to talk about the financial habits that make or break your audit outcome before the IRS contacts you. In my book, I go over what I call 5 fatal mistakes that destroy taxpayers' defenses when they're dealing with the IRS. This begins the section on mistake number 1, which is failing to prepare. And we're going to talk about how you can prepare to deal with an IRS audit. The first thing to talk about is bookkeeping and record keeping. Now, most people use these terms interchangeably, but that's a costly mistake. Record keeping is holding on to the proof. Things like receipts, invoices, bank statements, contracts. These are the raw documents that proved what happened in your business. Bookkeeping is organizing that proof into a coherent financial story, categorizing transactions, tracking income and expenses, and producing financial statements, which often happens in some type of bookkeeping software like, say, QuickBooks is a very popular one. You need both record keeping and bookkeeping. During an audit, the IRS agent doesn't want just receipts. They want a clear narrative that connects your expenses to income-producing activities. A shoebox full of receipts, like I received at that hair salon, with no organized ledger is a nightmare for everyone, including you. So here's a story from the book. A business owner, and I'm going to call him John, trusted his CPA named Kristen to handle all the payroll tax filings. Unknown to John, Kristen had a health issue that affected her work. Returns were filed late, payments were missed, and after Kristen passed away, John's new CPA discovered nearly $1 million in accumulated penalties. Years of compounding failures that John didn't even know about. If John had been looking at his own tax account transcripts just once a year, this entire disaster could have been caught early. The lesson from this story is that you are ultimately responsible for your taxes, not your CPA. Even if you've hired them and delegated certain tasks to them, you ultimately are responsible and who the IRS will come after. So now let's talk about 5 bookkeeping practices that protect you. And here's what I recommend to clients. Number 1, track income and expenses with a chart of accounts tailored to your business. You need to use a bookkeeping software and tailor the accounts to your business so it's easy to use and gives you useful information. Reconcile your accounts monthly. This helps you catch errors before they compound into much bigger issues. Number 3, maintain a mileage log if you deduct vehicle expenses. This is one of the IRS's favorite audit targets, and many taxpayers don't keep a proper mileage log. Number 4, you should also keep a log for meals and entertainment. Who you met with, what the purpose of the meeting was, when, and where. This is important, and you can do this just by writing on the receipt too, but for meals and entertainment, the IRS heavily scrutinizes those categories in an audit frequently, and you need to be able to prove all of that information. And step 5, keep your business and personal finances completely separate. Commingling is a red flag and can lead to not just tax issues, but legal issues down the line. Finally, I want to talk about how long to keep records. So the general rule, and this is based on the statute of limitations, is that the IRS can audit you for generally 3 years from when you file your return, the later of the due date or when you file your return. So you're going to want to keep your records for at least 3 years in the case of an IRS audit, but you're probably going to want to keep them for a little longer just to be safe, because there are exceptions. If you underreport your income by more than 25%, the IRS has 6 years to audit you. If fraud is suspected, there's actually no statute of limitations, meaning the IRS could go back to any tax return. So my general advice is, when in doubt, keep it longer. Nowadays with cloud storage, if you're able to scan and upload your documents, storage is cheap. Dealing with an IRS audit is expensive. So when in doubt, keep it longer, but generally at least 5 to 7 years should cover your bases. But before I go, if you found this valuable, I want to make sure you have everything you need to protect yourself from the IRS. And that's why I'm giving away a free copy of my book, The IRS Survival Guide. And all you have to do is go to theirssurvivalguide.com. So you can head there now, grab your free PDF copy, or check it out on Amazon if you prefer to read a physical book, and arm yourself with every strategy in this book. So don't wait until the IRS comes knocking. Get prepared today. So thanks so much for watching. If this video helped you, please subscribe and share it with another business owner. And until next time, thanks again for watching, and I will see you in the next video.